Good morning and welcome to this Wednesday, June 9th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're 24 hours away from a pretty big inflation report. The CPI for May will be out tomorrow morning. Very interesting week of trading so far, though. Not really what I would have expected, given what we saw last month and just given the nature of what we would think would be some pretty hefty inflation numbers. Headline, this isn't anything that the market professionals don't know. So I would have expected maybe a little bit of selling ahead of time. I'm not quite sure what to expect from that, except it's hard to take anything bearish away from this. I mean, I think if anything, you have to be a little bullish watching us approach this next big inflation number with 10-year treasury yield declining. Gold yesterday, the worst performing industry group. Yeah, I mean, there's just, you got the NASDAQ continuing to move higher with a lot of the growth stocks, the IWF versus IWD hanging in there. I mean, I would have thought maybe we'd have been on the verge of a breakdown with this big inflation number coming. Just things not making a whole lot of sense. The S&P 500, which hit right up against all-time high closing resistance on Friday. We're sitting right there still 2 days later. So all these things are telling me that maybe what the market is doing is simply anybody who wants to sell at resistance market, the market's taking your shares. And as we get this information, I'm not going to be surprised if we see a breakout rather than a breakdown. So some things to watch, though. Definitely the 10-year treasury yield. If you've got an inflation problem coming, there should be selling of treasuries. I mean, that's kind of a given with inflation. You don't want to be holding treasuries and a fixed income when inflation is going to be a problem. So that would be an obvious thing you'd be selling. So yields should be going up. They're not. Anyway, a lot of things to talk about. We're going to get into all that in just a couple minutes. But first, do want to just take you over to earningsbeats.com, where we are still running our spring special until Tuesday of next week, Tuesday, June 15th. So you still have about another week to jump in. You can click on that if you want some details. That'll take you to a page where you can see a lot of the things that we offer. And also key is the price, $9.97 for 14 months. Normally our regular monthly is $147. So that $9.97 for 14 months, 52% savings. So please check that out before it's too late. We've got another week or so through next Tuesday for you to check that out. Also, always like to welcome folks into our Earnings Beats Digest community. It's a free newsletter. All you need is your name, email address, hit that subscribe button. We publish an article 3 times a week, Mondays, Wednesdays, and Fridays. I try to focus mostly on education, but some of these do turn out to be pretty good trading candidates. They cover a whole wide range of topics: earnings, relative strength. Sometimes our short squeeze chart list is featured. I mean, the short squeeze has been a topic that's been kind of in play again here, kind of like it was back in January. I don't know if you saw Clover, CLOV yesterday. That's on our short squeeze chart list. Stock was up, I don't know, 80% or whatever it was. It was up, I think I saw another 30%, 25, 30% this morning. That short squeeze chart list it's not a list where I would just go in and just haphazardly buy whatever stocks on the list. Most of those stocks are being shorted for a reason. They're not performing well. But when you get these stocks that break out and you see the volume picking up, they trade irrationally, and you can make a lot of money in a very short period of time. They are risky, very aggressive trades, so probably not for everyone. But if you're into that kind of thing, I think the short squeeze chart list is really one of our big selling points for our service, along with market guidance, a lot of other chart lists, our research, everything. But anyway, it all starts really with our free newsletter. So type in your name, email address, hit that subscribe button. There's no credit card required, 100% free. You can unsubscribe at any time. All right, let's move on to what happened on Tuesday. And you can see the Dow Jones was down earlier, came back, rallied back. Same goes for the S&P 500. I mean, we finished at 42.27, which was up a fraction, up about 3/4 of 1 point. 42.3260 is our all-time high close. And we've been right up against it now for the last 3 days, last Friday, and then on Monday, and then again yesterday. 3 days in a row, we're just beating up against this resistance level. And it's going to be very interesting to see what happens when this news comes out tomorrow, because I'll be shocked if it's tame. I think inflation, I don't know that the current month is going to be that big, but remember, we're dropping May of 2020 off of this year over year comparison. And that was a down period on inflation. So if anything positive, and we're going to move to the highest inflation level year over year that we've seen this decade. And so that's kind of a big deal. Although the Fed's been saying it's transitory, I believe it's transitory, and yet we're still seeing it grab a lot of headlines. So what happens tomorrow when this news hits? It's anyone's guess, but I will say I'm pretty impressed by the market's resiliency here, continuing to trade up near highs, knowing that this report's coming out. This isn't going to be a shock to anyone. No one in the know is going to be shocked by this. If you've been following inflation, you know how it works. It's going to be a big number. And yet the market seems to be shrugging it off, which again, I think is a good sign. The NASDAQ, as I mentioned, continues to outperform. Look at it breaking out to a new 1 month, actually probably maybe 5-week high, up 43 points yesterday. This is an index loaded with growth stocks. Growth stocks don't perform well during inflationary periods. So here we are on the verge of getting that big inflation report, and yet we're just trekking higher with the growth stocks. Got to at least sit back and wonder. It's more about what's happening in the market and less about what people are saying. That's always the case. Follow the charts. Mid caps up 24 yesterday. Another nice move, bouncing off that 20-day moving average, closing at the highest level in about a month. Small caps continuing just to charge higher. All of this is really good. Now, you do need to understand the makeup of small caps. Small caps don't have nearly as much representation of technology and consumer discretionary, and have a lot more of financials, industrials, but also energy, a lot of small cap energy names. And so energy, because energy's been doing so well, and you can see down here, energy, the best performing area of the market on Tuesday. And as a result, that's helped small caps. So small caps making another run. And when you look at it, making a run with energy, and you look at another key area like discretionary, which small caps don't have nearly as much representation as the S&P 500, and that group hasn't been performing well. I would say it's been one of the worst performing groups, maybe along with utilities here. Anyhow, moving on to these sectors, you can see energy, discretionary, and real estate. These were the three hot groups. I did write about real estate yesterday. I think you have to be a little careful with this group in the near term because they have made such a huge run up. On their 60-minute charts, there's a negative divergence. Now, that doesn't mean that this is going to be a long-term top, but I think it probably is getting close to a time when we're going to see a little bit more selling in the near term. Real estate, maybe some rotation out of real estate. You might see it. We may have a bad inflation report tomorrow. You'd think that would be good for real estate, but I would argue maybe it's already been built in, and that all of the selling that we've seen in the NASDAQ over the last few months, all of the selling has been built in, knowing that we're going to have these inflationary numbers. So now that we're getting what I think might be the highest number we're going to get, I think this could be the high. Maybe we go a little higher over the next couple of months, but I believe this could be the highest month that we get. Maybe the market has already priced all of that in, and what we're going to see is real estate sell on the inflation news, and these growth stocks continue moving to the upside. We're going to find out in 24 hours when the news hits, see how Wall Street reacts. Anyhow, utilities down. I'm still watching at 64 level. Utilities, that was the worst performing sector on Tuesday. Also wanted to mention gold, and I mentioned this at the top of the show. I mean, just from a common sense perspective, I mean, gold, one of the things you buy gold for is to hedge against inflation. And yet here we are heading into what should be a really big inflation number, and gold's been going down for the last 3 weeks. Makes no sense. Historically, you think everybody would want to be buying into gold. Now, when we get the news, do we get one more pop to the upside? Again, we're going to find out tomorrow. 10-year Treasury yield. Let's get a quick update, see where we are there. Find it very interesting right now. We are down another 4 basis points today. Again, right here on the doorstep, the eve of the biggest inflation number we're going to see this decade, this century, that we have seen this century. And the yield goes down again. And now we're below 150, which is kind of a big deal. I mean, 150 is where we topped and then made one more push back up to about 175. So we've been in this range from 150 to 175. And I would have been pretty convinced, and it's not that I'm not convinced, but I would have thought we were going to break out to the upside on the yield. That's what I've been calling for, figuring with better economic data ahead that was what was going to drive the yield higher. And then throw in the inflation data. Higher inflation should lead to higher yields. And here we are on the verge of this big inflation report, and we're moving to a 3-month low on the 10-year Treasury yield. It's not what they're saying, it's what the market's doing that you need to pay attention to. And the market right now is saying inflation is not a problem. So we'll find out what happens. But watch that 10-year Treasury yield today, and more importantly, watch what happens to it tomorrow. Because if this yield breaks back down to the downside, these growth stocks are going to explode. I think they've been held back partly because of the inflation fears that, in my opinion, not really that big a deal. And then the fact that interest rates have just been rising, which they're rising off of historic lows. Growth stocks, if you had asked anybody looking, managing or investing in growth stocks for the last 40 years, would you like to have an environment where GDP is 6%, 6.5%, and the 10-year Treasury yield is sitting at 1.5% or 1.7%? Those managing growth would tell you every time that I'll take that 100 out of 100 times. High growth, low interest rates, historically low interest rates. That is nirvana for growth stocks. And you say, well, why they perform so poorly? Well, they were overbought. That's the way the market works. You get big runs and then you settle down, you consolidate. Money rotated out of growth for a while. The whole theme moved from growth to opening up the economy, the reopening of the economy. So all that money came out of growth, which I've been saying all along, I think is setting up as a tremendous opportunity for these growth stocks going forward. Now, whether or not it's going to be in the fall or whether it's going to be now, that is up for debate. But I'm a big growth stock fan. I've continued to be a growth stock fan. I'm a big secular bull market fan. I don't think inflation is a problem. I don't think interest rates are a problem. Give me a break. I mean, 1.5%. This is crazy. But one thing that you do have to be careful of is if the yields start to move back down, this run in financials and possibly to a lesser extent in industrials, I'd be really careful of if you see that yield not responding to this inflation. And keep in mind the jobs number that came out last week was below expectation. So the market prices in their expectations. And when you start seeing things less than expected, like growth, that's going to take some of the pressure off of the Fed having to raise rates. And if the market's buying into this transitory inflation theme, I don't see, I see yields staying relatively low for the foreseeable period, which should play right back into the hands of growth stocks. So I think the next week is dicey. I mean, we have CPI tomorrow, we have PPI on Tuesday, we have a Fed meeting Tuesday, Wednesday, but the market anticipates, and if the market believes inflation's not a problem and that the Fed is going to stand pat and remain accommodative, I think you're going to see the response continue to be stronger in the NASDAQ and in those growth stocks, but time will tell. All right, let's keep moving here. I want to talk a little bit about gold because, we are on the, like I said, on the verge here of having a big inflation number. And you can see gold since, March, when a lot of the growth stocks fell out of favor, you can see that gold kind of came back into favor. And we've seen a pretty big move here over the last few months. Short term, it's been looking pretty good. And if I move to a 5-year weekly chart, you see gold looking pretty good. I mean, nice uptrend. Maybe call this a little cup, pulling back in a handle. Everything looks great, right? So I get emails. Why don't you like gold? Why are you not a fan of gold? Well, it all comes down to relative strength for me. It's not just, is it going up? Everything's been going up. The stock market's been in a secular bull market for I mean, some argue that the bull market started in 2009. I don't agree with that because you don't know that it starts then. You don't know until you take out highs, until you break out. And so for me, the secular bull market began in 2013. That's when we cleared the 2000, 2007 highs on the S&P 500. So we're 8 years deep into this secular bull market, and these secular bull markets tend to run 2 decades. That's why I remain very bullish. Doesn't mean you don't have cyclical bear markets from time to time. 1960s, we were in a secular bull market, but we had 4 recessions. So don't think the secular bull markets mean you just go up every day. That's not the case. It's a long term, it's big picture. Over the long haul, these secular bull markets is where you make your wealth. This is where you make your money. You don't do it during secular bear market periods like 2000 to 2012, where the market goes nowhere for 12 years. Anyway, when you look at this, you say, well, gold looks good, but I want to show you a chart of the relative strength of gold versus the S&P. Now, this is the same 5-year chart that you just looked at. Here's the absolute chart, which shows it going higher. And then here's the relative chart showing you how it's performing versus the S&P 500. When we had the panic back during the pandemic, you can see right here the huge move up in gold relative to the S&P. But coming out of the pandemic, as fear has subsided, gold is not a good relative performer. It's been going down. Now, the last 3 months, we've had interest rates moving up. We've had problems with growth stocks. We've had these inflation concerns. All of that, I think, has helped gold. But here we are heading into one of the biggest reports tomorrow, and look at gold over the last few weeks, downtrending versus the S&P 500, and its relative PPOs at the center line. It's not even positive. So I'm just not a fan of gold on a relative basis. If you're trading it, it's been fine. On an absolute basis, it's been going higher. I would just keep my stops in play. I'm not going to bring up a chart because I talk about this often. But the other thing I don't like about gold is I still believe that the dollar is going to go up later this year. And anytime the dollar is rising, gold is not where you want to be historically. The relative weakness of gold positively correlates to the dollar rising. Now, the dollar has been weak in the last year, and so that has helped commodities in general, and it's helped energy and the material sector. But even with all of that going on with a weak dollar, look at what gold has done on a relative basis since May of last year. So that's why I tend to stay away. I mentioned growth versus value, and this is what I'm looking at. So growth last month, I think the CPI report came out on May 12th, and I think PPI came out on the 13th. I believe that was the case. And so heading into that report, you can see growth stocks being sold off. And we went back and we tested the low in March on a relative basis. But since then, as we move closer and closer to this next inflation report, I'm not saying we're out of the woods yet on growth stocks. Maybe this is a head fake to the upside on some of the growth in NASDAQ and the overall S&P. I mean, we haven't broken out yet. So maybe tomorrow morning we get this big headline number and we get the big sell-off and we see growth stock sell-off. That's why, for me, it's just such a difficult period to try to, I think this is kind of a big deal because I think the theme in the market is at stake here. It's not just does the market go up or down, but it's also the rotation within the market that I'm trying to figure out. If you break down this IWF-IWD ratio, you don't want to be in growth stocks. But if we have a big inflation report and rates still drop, yields are dropping, and growth breaks out versus value, breaks back above 161 and starts to trend up toward that 167, 168, 169 level, that would be very bullish for not only growth stocks, but just the market in general. And then, of course, throw in the summertime. We know the stock market historically doesn't do as well over the summer. So if inflation picks up and then we see growth roll back over again and we're in the summer, that tells me to be more cautious. So there's two sides of this coin. And to be honest, going into tomorrow, I think we could flip this coin 50 times and probably come up 25 on each side. I just don't feel, I am, I guess, leaning because I have a bullish belief overall in the market. And so I tend to lean that way. I mean, I think anybody who's followed me probably knows that. Some of you think that's maybe a fault of mine. I don't. I mean, I think the market keeps going higher. So I think that's, been a testament, to the secular bull market theory. But I just feel like the way the market has been handling this heading into this report has been bullish. So I'm if I had to lean one way or the other, I think maybe we get a headline number, we get a gap down on growth stocks, and then they come roaring back again. That's kind of what I think is going to happen, but it's a guess. It's literally a guess. All right, I've been showing a lot of relative rotation graphs recently, and I think this is a really cool way. I like using the price relative ratios on stock charts. I don't know, maybe it's because I'm a numbers guy, having been in public accounting for so many years, and I don't know, I just like the ratios and numbers. But visually, the RRGs probably are better for most, I think, looking at the market to see what truly is going on. So this is a weekly look at the sectors relative to the S&P 500. So you can go back to a year ago and see what was going on. And all they do is rotate around this center axis. And the center axis is the benchmark S&P 500. So it's telling us, when we're above this center line, this horizontal line, that tells us we've got good momentum. When we're to the right of this vertical line, it tells us we've got great relative strength. So when you're up above this horizontal line and to the right of this vertical line, up here in this leading quadrant, it's telling you your momentum is picking up and you're also showing relative strength. That's a great combination. And so you can see back when the positive vaccine news hit, look what really took off: energy, financials. And they've continued to stay strong throughout this process. Now, we went through a period there, we can see energy really pulling back, momentum weakened quite a bit. Now we're below this horizontal line, but we're still right of this vertical line. So we still have relative strength. And what you normally will see on these charts is when you have strong leadership and it weakens for a period of time, many times it'll come right back up. So don't be surprised to see on a longer term picture, energy start to turn back up again. Now, if I change this from weekly to daily, you can maybe start to fast forward and get a better look at what's happening. So look at what is going on right now in energy. Look at energy turning back up on the daily. See how some of the others keep moving toward the center line? Energy is not going back. It's holding its relative strength and its momentum is starting to pick back up again. So that's the daily chart, which tells me probably that weekly chart that we were just looking at, we're likely to see that one turn up as well, just a matter of time. Real estate continues to be strong. Look, this is the part that I find interesting and why I wanted to show you this chart. Here's technology quietly moving back into the leading area. Now, this is on the daily chart. This is going to happen much quicker, obviously, on a daily chart than it will on a weekly chart. Let's go back and look at that weekly chart. And I want to identify the technology group. You see where we are on the weekly? We're still on the left side relative strength. So we're relatively weak. Our momentum's picking up a little bit, but we haven't even crossed over that horizontal line yet. So we're still in the lagging group on the weekly, but the daily is telling us things are definitely improving in technology. So as we get ready to unleash this inflation report, are we going to see technology? Are we going to see this group stay over here in this lagging area? Is it going to turn back down? Or is that daily chart that we were just looking at with technology moving in, are we going to really start to strengthen? This will be an interesting RRG to watch here over the next few days and maybe through the Fed meeting of next week. Does technology, through all of this inflation and then the Fed report, do we continue to see strength short term in technology? I think that would be a really bullish sign if it happens. All right. Another thing with relative strength, we have a chart list at Earnings Beats, and all of our annual members, we send this. You can download this into your stock charts account, but it's all 104 industry groups. and it's relative to the S&P 500. So yesterday, for instance, the worst performing group, as I pointed out at the top of the show, was the miners. So gold mining and mining in general. And here we can just pull up, this is a 3-year relative chart of gold mining versus the S&P 500. Then on the bottom of the chart, you'll see the absolute chart. So here was the breakout, but that breakout, and actually at this point, it's turning out to be a false breakout. 156 was the prior high. We broke out and we went back down. We closed to 154. So right now we got a false breakout on the gold miners, and you can see the relative weakness beginning to accelerate again here a little bit, all right ahead of the inflation report. Just wanted to point it out. But what you can do with this is to take a look to say, okay, well, what about, let's look at the last week and, what's working, what's not working. Well, look over the last week. These are, the way I set these up is I have a number for each sector. So 001 is technology. In this case, 0011 is materials, XLB. And I do this just so I can quickly glance rather than look at the industry groups and then not know or have to think about, okay, which sector are they in? It's already laid out here for me. So you can see over the last week, materials, 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 materials. This is heading into what's going to be a big inflationary report. Why are material stocks performing so poorly over the last 5 days heading into the, you'd think that Wall Street would just be jumping in hand over fist into this group. So I'm just wondering if we're going to get a last inflation hurrah, and we're going to get a big number tomorrow, and all these groups are going to jump, and it's going to be one final leap to the upside before inflation dissipates, the dollar starts to rise, and materials begin to roll over. I'm not saying that's going to happen. I follow the charts, and materials have been a great performing area of the market, no doubt about it. But this just makes me think, materials underperforming for the week heading into a big inflation report. Does that make any sense? Doesn't to me. And then the same week, energy, which should do well with inflation and with, of course, higher crude oil prices, which we've been seeing, energy's at the top. So what's going on with materials? Why wouldn't they be performing well? Anyway, look at, here's a technology group, renewable energy. Over the last week, renewable energy has caught fire again. The telecom equipment group doing pretty well. Computer services near the top. Computer hardware, software. These are all in about the top 20 out of 104. So we're seeing a little bit of that rotation back. And again, that's kind of the theme, and that's something we want to really look at here over the next week as these inflation numbers come out. Don't pay attention to the headlines. Don't pay attention to what you're seeing in the financial media. I'm telling you, don't do it. They would have had you selling for the Great Depression a year ago during the pandemic. That's not what the charts were telling us. Follow what the charts are telling us and follow the themes that are playing out in the market. Don't follow the clickbait headlines. All right. Let's take a look at earnings, just a couple of earnings reports. The first one that had come out yesterday, or one of them that came out yesterday after the close. This company hasn't been public very long, but I think it's $38 billion company. So it was by far the biggest company that reported yesterday. This is UiPath. They reported earnings of 2 cents versus an expected loss of 5 cents. Don't know, maybe we can take a look here at what they're doing pre-market. Stock down 8.5%. So obviously they didn't perform well enough. They beat, but they didn't beat by enough, or maybe they lowered guidance. I didn't see. But that takes us down to 69.47 right now, which is still above the recent support. I'd be looking at support 62.5, resistance up near 85, 85.5, something like that. Casey, pull that up. Let's see what it's doing pre-market. It is also down 4% to 205. So it's down to about here. Been uptrending. got a little ahead of itself, rolling back over. You can see the weakness, relative weakness here. I don't know. This one, I'd probably have to sit back and watch this. I'm not so sure I'm excited about this. This morning, Campbell Soup, or Campbell Foods, CPB, came out. They announced, and okay, the market has opened. So let's take a look and see if it's, wow, down to 45. This stock, they did miss 57 cents versus 66, and all the way back down near the recent lows here. Probably going to rebound, I would think, off of that. If not there, I think you'll see a rebound from 44. So off of this weakness, it's probably a buy. My problem with Campbell Soup is it's just a slow mover. So as a short-term trader, trying to make some decent money in a short period of time, I don't know that Campbell Soup is the right stock. But because it is getting beaten up so bad, everybody's selling at the open, you probably have market makers on the long side. Don't be surprised if we do pull back and then it comes back through that opening price again. That might not be a bad time. Maybe you get $1 out of it, something like that. That may be appealing to some, maybe not so much to others. Another company that reported that actually blew away estimates. This is the Lovesac company. It's in the furnishings area. Stock was expected to lose 55 cents. They actually made 13 cents. Let's see what's going on here. And the stock is barely trading up 1.5%. But that was a great report. Keep in mind, a lot of this was already built in. Stock a week ago was up to 95 and change. I wouldn't be surprised actually to see this make another run to the upside, just based on the way it's been trading. That was pretty solid news. I didn't see revenues. I didn't see the forecast. So I'd want to look at that first. But overall, I think this chart still looks pretty good to me. All right, let's wrap this thing up. Oh, by the way, later today, GameStop. So one of the big meme stocks, GameStop will be out with their earnings. And do you believe they're going to post something to justify a $300 a share price when 6 months ago the stock was, or 9 months ago it was $5, $6? I don't know, $299. They should be, I don't know, mining gold or something for, to have this kind of valuation. But things are crazy right now, and I would have thought the whole GameStop mania from back in January would have wound down. It really hasn't. So that'll be an interesting earnings report to watch after the bell, GME. All right, let's look at the 3 you must see to wrap this up for today. I'm going to start with DraftKings. DraftKings is actually starting to strengthen again. Now, this is a key area of resistance. I'm going to say 55 to 60, because 55 to 60 served as resistance back here in December, January. It also served as really good support for about 3 months. We broke down on big volume, and now here we are moving into this 55 to 60 area. So this might be an area where we top somewhere in here, pull back, and if we get that 20-day test and growth stocks are back in, in vogue, I think DraftKings could be a great stock. I'm going to update this because this was prior to the open. Let's see what it's doing today. It's up just a fraction, up about 1%. But right in this area, I do think we could run into some difficulties with DraftKings just because of the history. This area has been tough. Another stock that's been suddenly booming again is Alta. So Alta gaps up, challenges that 350 high. Look at that false breakout. That to me is one of the, if I'm in a stock and I'm looking for resistance and I'm riding this stock up and I'm thinking, wow, intraday, I got a breakout. One of the first things that goes through my head is, if we don't get this breakout, I'm selling. I don't want to hold through a false breakout. And the reason is pretty clear on this chart. Next 4 days, we're down, back down to the moving averages, a little below gap support, not a horrible thing. Long term, it's probably not going to matter. I think Alta is going to break out. Short term, to a trader, it matters a lot. If you can get out of a stock at 345 and get back in at the 20-day or gap support, $15 or $20 cheaper, I'll do that every time. So yeah, you want to pay attention to these signals. But Alta is bouncing back up. I think Alta looks really good. Eventually, and I'd almost long-term look at an uptrend, a cup, handle back to the 20-day, breakout above 350, very, very bullish for Alta. And I think that would measure on the stock up to 400. So that's what I'd be looking for there. Last one I want to mention is a big breakout by a company I had not looked at in a long time, and that's Sirius. So XM, if if I can get it to come up here for us, Sirius XM Holdings. Look at the big volume and the breakout. Now you say, well, it's a 1 year breakout. Well, let's pull up a 5-year weekly chart, and you'll see that this goes back to this high back at February of 2020. And then also at 740 or so was the high in June of 2018. And if you pull up a monthly 15-year chart, we're on the verge of a major breakout on Sirius XM with the volume picking up yesterday. Now, we haven't made the breakout, and so many times these stocks will go up, probably get a false breakout, and we'll maybe get an opportunity to get in cheaper. But I just wanted to point out this is a stock to keep on your radar. Really nice breakout here on Sirius. All right, that's it for me. Let's get a quick update on the market, see what we're doing here in the first 5 minutes of trading today. Are we breaking out? Well, there we are, S&P right at 42.33 again. Mornings, we keep trying it, and then we, fall back, and then we come rallying back at the end of the day. I don't know, is this one going to be any different? Are we going to break out with gusto the day before a big report? Is growth going to lead in that move the day before we get inflation numbers? That would be a statement by the bulls. So I don't know. We'll see what happens. But at least for now, we got NASDAQ on the verge climbing back above 14,000. S&P 500 on the verge of setting a new all-time closing high. 42.3260 is the number to watch. And overall, small caps, mid caps giving back a little bit, but they had a strong day yesterday. Anyhow, that's it for me. I'm going to be back tomorrow at Stock Charts TV with a recorded version of Trading Places Live. So you can join me by going to stockcharts.com, clicking on that Stock Charts TV at the top of their page, and then at 9 o'clock, the show will begin. Again, that will be a recorded version, so I will not have the inflation data, unfortunately, when I have to make that recording. But later this year, I am hoping, maybe later this year into early part of next year, I'm hoping we get back into live shows over there at Stock Charts as we get past the pandemic, and Stock Charts folks there get back into the office full time. It's much easier to do these live shows when they're able to be in a studio. So anyhow, that's it for me today. Everybody have a great day, and be back tomorrow over at Stock Charts. Happy trading, everybody.